$83.49. That is where silver sits right now on February 9th, 2026, rebounding 7% in a single day after experiencing the most violent crash in precious metals since the Hunt brothers tried to corner the market in 1980. Just 11 days ago, silver hit an all-time record of $121.78 per ounce. Then within 48 hours, it collapsed to $76, a 33% wipeout that erased weeks of gains and sent shockwaves through global commodities markets. But here's what makes this story absolutely fascinating. The same analysts who warned this crash was coming have now completely reversed their positions. They are turning bullish. And the data behind why they are changing their stance could reshape your entire view of silver for the rest of this year. If you want to stay ahead of moves like this before they happen, hit that subscribe button right now because we are about to break down exactly what caused this historic collapse, why the fundamentals may be stronger than ever, and what the biggest investment banks on Wall Street are telling their clients to do next. Let me walk you through precisely what happened because the timeline matters enormously. Silver entered 2026 absolutely on fire. The metal had already delivered a stunning 150% gain throughout 2025, making it one of the highest performing major assets on the planet. By late January, silver broke above $100 per ounce for the first time in history. Reddit forums were buzzing with 20 times their normal chatter about silver. Retail investors poured a record $1 billion into silver funds in January alone. On January 26th, trading volume in the iShares Silver Trust ETF nearly matched the entire S&P 500's main fund. On January 29th, silver touched $121.78. Everyone thought they had found the trade of a lifetime. Then came Friday, January 30th. Within hours, silver collapsed from above $121 down to $76. Gold dropped 12% on the same day. This was the largest single-day decline in precious metals in over 4 decades. What triggered it? The immediate catalyst was President Trump's announcement that he intended to nominate Kevin Warsh as the next Federal Reserve Chair. Warsh is widely viewed as an inflation hawk who has previously displayed strong views against a large Fed balance sheet. Markets immediately perceived this as a signal of potentially less aggressive monetary stimulus going forward, and non-yielding assets like silver took the hit. But here is what most people missed. The crash actually started about 3 hours before that announcement. The real mechanics behind this collapse were far more complex and frankly more concerning for anyone trying to understand what silver might do next. The CME Group raised margin requirements on silver futures contracts twice within 1 week heading into the crash. For silver futures, initial margin requirements rose to $25,000 per contract. With silver at approximately $75 per ounce, a standard 5,000-ounce silver contract carries roughly $37,500 in notional value. That represents approximately 15 to 1 leverage against the margin requirement. When those margin calls hit, highly leveraged speculators had to either pour massive amounts of capital into the system or close out their positions instantly. Most chose to sell, and selling begat more selling. The Shanghai Futures Exchange implemented multiple rounds of restrictions throughout January as well. Add in the fact that January 30th was the final trading day of the month when liquidity typically thins and price moves become exaggerated, and you had the perfect storm for a cascading liquidation event. According to Trading Economics, this crash briefly erased nearly half of silver's value from its peak. U.S. Treasury Secretary Scott Bessent attributed last week's extreme swings to Chinese traders, describing the recent top as a speculative blow-off. Now let me give you the exact current state of this market. As of February 9th, 2026, silver is trading around $80 to $83 per ounce. The 52-week range now spans from approximately $29 at the low all the way up to $121.78 at the high set on January 29th. Despite this brutal correction, silver remains up approximately 160% over the past year. Let me repeat that because it matters. Even after losing a third of its value in 1 day, silver is still more than double what it was trading at 12 months ago. Technically speaking, silver found strong support at the 50-day exponential moving average near $70.81, which coincides with historical peaks from late 2025. According to analysts at TradingView, if silver holds this area and allows markets to calm, we should expect a demand response rather than continued supply pressure. Even if selling continues, silver has substantial support ahead at the 200-day exponential moving average around $55 per ounce. Here's where this gets really interesting. I want to share with you what some of the most respected names in commodities are saying right now. Peter Brandt is a 50-year commodities trading veteran whose career began in 1976 with Conti Commodity Services. He accurately predicted the 2011 silver top, and he predicted this crash as well by comparing the current parabolic spike to that same 2011 pattern. Now that his warning has proven correct, Brandt has returned to share a new view. He wrote on X that 2026 is not 2011. In his mind, the 2011 rally was destined to return back to the teens. Not this time. He believes there is more ahead for silver, but not until the hotshot, know-it-all bulls are thoroughly washed out. Then price can go back up, maybe not until later in 2026 or even early 2027. Former JP Morgan strategist Marko Kolanovic, whose career stretches back over 20 years and includes roles at Merrill Lynch and Bear Stearns before a 16-year run at JP Morgan that helped him get inducted into the Institutional Investor Hall of Fame, had predicted a 50% reckoning for the metal. Now that the crash has occurred, Kolanovic has also shifted gears and is tactically turning bullish. Think about what this means. Two of the most respected voices in commodities who warned about this crash before it happened are now telling you the next move could be higher. The major investment banks are maintaining their bullish targets despite the volatility. UBS strategists said they view the sell-off as normal volatility within a continuing structural uptrend rather than the end of the bull market. They forecast that spot silver will return to the $100 threshold by next month before falling back to $85 by the end of the year. Goldman Sachs expects silver to average between $85 and $100 per ounce in 2026, viewing it as the primary strategic metal of the green transition. Citi has issued a target of $110 for the second half of 2026, citing an acute shortage of physical silver available for immediate industrial delivery. On the gold side, which directly influences silver, JP Morgan analysts expect gold to reach $6,300 an ounce by the end of 2026. That represents a 30% gain from current prices. Goldman Sachs has a $5,400 price target on gold and sees significant upside risk to that forecast. Bank of America has an even more bullish $6,000 target. But you deserve the full picture, so let me give you the counter-arguments as well. UBS warns that high silver prices reduce industrial demand. With more than 50% of demand linked to industrial applications, current prices are likely to result in reduced industrial demand over time as end users seek to optimize silver usage and lower input costs. Goldman Sachs analysts were warier of silver than gold, specifically because of supply constraints in the critical London market. ING's commodities strategist Ewa Manthe noted that over the coming weeks, the pace and sustainability of any further gains will be shaped by movements in the dollar, interest rate expectations, and risk sentiment, with precious metals more likely to climb at a steadier pace rather than repeat the explosive rally of the past 3 months. Let me explain why the fundamental case for silver remains intact despite this volatility. Central banks purchased 248.6 tons of gold in the first quarter of 2025 alone, the highest quarterly purchase ever, and that momentum carried into 2026. Central banks from China, India, Turkey, and Poland are still buying massive amounts of gold and silver. The U.S. government still spends far more money than it receives. Geopolitical tensions remain elevated with uncertainty about trade policy and global conflicts driving safe haven demand. For silver specifically, the supply squeeze is not a recent development. It is the continuation of a long-term trend. For 4 consecutive years, global demand has exceeded mine output, creating annual shortfalls averaging about 170 million ounces. The Silver Institute expects 2025 to mark the 5th year in a row of deficits. China has reclassified silver as a strategic material and is restricting exports, fragmenting the global market, and exacerbating supply shortages. Here is a data point that should grab your attention. During the first week of January 2026, COMEX warehouses experienced a 33.45 million ounce withdrawal in just 7 days, representing 26% of registered inventory vanishing in a single week. Silver lease rates exploded to around 8% compared to the typical 0.3 to 0.5% range, signaling the market is short of silver to a clearly abnormal degree. The industrial demand picture keeps getting stronger. Every solar panel needs about 0.64 ounces of silver, and with hundreds of millions of solar panels being installed every year, this adds up quickly. The artificial intelligence revolution is driving demand, with semiconductors expected to consume 23 million ounces by 2030. Electric vehicles use twice as much silver as gas-powered cars, about 1.3 ounces each. Tens of millions of these cars hitting the roads in the next few years could continue to spike demand and ultimately silver prices. For investors considering action, here are the specific levels to monitor. On the upside, watch the $87 resistance level. A clean break above that opens targets in the $92 to $100 range. On the downside, $81 is the first key support, followed by $76.45 and then $70.81 at the 50-day moving average. A break below $70 would signal potential for a deeper correction. The $55 level at the 200-day moving average would be the line in the sand for the bullish thesis. If you are looking to establish or add to positions, advisors typically suggest allocating no more than 10 to 15% of a portfolio to silver specifically, and capping overall precious metals exposure at 20%. Given the extreme volatility we just witnessed, consider scaling in rather than making one large purchase. The volatility we just witnessed is unlikely to disappear overnight. I want to be crystal clear about the risks here. Silver just experienced what some analysts are calling 3-6 sigma events in 1 week. A statistical impossibility under normal conditions. The precious metals market remains in a state of elevated volatility. If the Fed pivot does not materialize as expected, if inflation cools faster than anticipated, or if the dollar strengthens significantly, silver could face additional pressure. A sustained break below the $55 200-day moving average would force a complete reassessment of the bullish thesis. Now I want to hear from you. Did you get caught in this silver crash, or did you manage to avoid it? Are you viewing this as a buying opportunity, or are you staying on the sidelines until the dust settles? Drop your thoughts in the comments below because I read every single one, and your perspective helps everyone in this community make better decisions. Here's what I will leave you with. Diego Franzen, head of portfolio strategies at Planisphere Investments, said something that perfectly captures why precious metals matter in today's world. In a world where almost every financial activity incorporates credit risk, gold and silver remain the only assets without a counterparty. They make no promises, pay no interest, and are not dependent on political decisions. They simply exist, and that is precisely why they provide security. The silver crash of January 2026 will be remembered as one of the most dramatic corrections in precious metals history. But history also shows that panic selling into a structurally intact bull market creates opportunity for patient investors who understand the difference between price and value. If you found value in this analysis, smash that subscribe button and turn on notifications so you never miss these market-moving insights. More deep dives on precious metals, currencies, and global markets are coming your way. This is educational content only and should not be considered personal financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.